Welcome to Peace Mind, the home of fascinating book summaries, powerful ideas, and life-changing lessons. Today, we are exploring The Intelligent Investor by Benjamin Graham, one of the most influential investing books ever written. This is not a book about getting rich quickly. It is a book about patience, discipline, psychology, risk management, and making intelligent financial decisions over the long term. Benjamin Graham is often called the father of value investing, and his ideas deeply influenced legendary investors like Warren Buffett. The book teaches readers that successful investing is not about predicting the future perfectly. It is about controlling emotions, avoiding major mistakes, and thinking rationally while others become emotional. In this summary, you'll discover the difference between investing and speculation, why emotional control matters in financial success, the concept of value investing, how to think long-term during market chaos, and why discipline often beats intelligence in investing. So sit back, relax, and let's begin. Investing versus speculation. Benjamin Graham begins by making an important distinction. Investing is not the same as speculation. Speculation focuses heavily on short-term predictions and quick profits. Investing focuses on long-term value and rational decision-making. Many people enter financial markets emotionally. They chase trends, follow hype, react impulsively, but Graham warns that emotional investing often leads to major losses. True investing requires patience, analysis, and discipline. The intelligent investor focuses less on excitement and more on long-term stability. The psychology of the market. One of the most famous concepts in the book is Mr. Market. Graham imagines the stock market as an emotional business partner. Some days, Mr. Market feels optimistic and prices rise dramatically. Other days, he becomes fearful and prices collapse. The key lesson is this: the market itself is emotional, but intelligent investors do not blindly follow market emotions. Instead, they think independently. They use market fluctuations as opportunities rather than emotional traps. Fear and greed constantly influence financial markets, and people who cannot control emotions often make poor decisions. Emotional discipline. According to Graham, investing success depends more on psychology than raw intelligence. Many intelligent people lose money because they become emotional. Fear causes panic selling, greed causes reckless buying, excitement destroys discipline. The intelligent investor remains calm during market volatility because emotional reactions create irrational decisions. This lesson remains extremely relevant today, especially in the age of social media investing and constant financial news. Modern markets move emotionally faster than ever, which makes emotional control even more valuable. Value investing. One of Graham's most important ideas is value investing. This means buying investments based on their real underlying value rather than market hype. Sometimes markets become irrational. Good companies become undervalued. Weak companies become overpriced. The intelligent investor looks beyond short-term emotion and focuses on long-term fundamentals, business quality, financial stability, long-term potential. Value investing requires patience because markets do not always recognize value immediately, but over time, reality tends to matter. The margin of safety. Perhaps the most famous concept in the book is the margin of safety. Graham believed investors should leave room for uncertainty and mistakes. No one predicts markets perfectly. Unexpected events always happen. Economic crashes, wars, recessions, technological changes. The margin of safety protects investors from catastrophic losses. This principle encourages caution instead of overconfidence. It reminds investors that survival matters more than chasing maximum profit. Long-term thinking. The Intelligent Investor strongly emphasizes long-term thinking. Many people obsess over daily market movements. Prices rise, prices fall, headlines create panic. But Graham explains that short-term fluctuations often distract investors from long-term reality. Successful investing usually rewards patience. Compounding requires time. Small, intelligent decisions, repeated consistently over decades, create extraordinary results. This philosophy opposes modern obsession with instant wealth, risk, and human nature. Graham repeatedly warns readers about human psychology. Humans naturally become emotional during uncertainty. During market crashes, fear dominates. During booms, greed dominates. Most people buy when prices feel exciting and sell when fear becomes overwhelming. But intelligent investors often behave differently. They remain rational while others panic emotionally. This emotional discipline becomes a major advantage. Defensive versus enterprising investors. Graham explains that different investors require different strategies. Some people prefer simplicity and stability. Others enjoy deeper analysis and active investing. But regardless of strategy, discipline remains essential. The book repeatedly warns against excessive confidence. Many people believe they can predict markets consistently, but financial markets are deeply unpredictable. Humility protects investors from dangerous mistakes. Wealth and patience. One of the deepest lessons in the book is that wealth building is usually slow. Modern culture glorifies rapid success, quick money, instant profits, viral financial trends. But sustainable wealth often grows quietly over decades. Patience becomes a competitive advantage. Most people struggle with delayed gratification. They want results immediately. But intelligent investing rewards consistency more than excitement. Market crashes and opportunity. Graham explains that market crashes are emotionally painful, but they also create opportunity. When fear spreads everywhere, many valuable investments become undervalued. The intelligent investor does not automatically panic during downturns. Instead, they remain calm and analytical. This mindset requires emotional resilience because markets often feel most frightening during the best long-term opportunities. Independence of thought. One powerful lesson in the book is the importance of independent thinking. Crowds are often emotional. During bubbles, people become irrationally optimistic. During crashes, fear becomes contagious. Graham encourages investors to think critically instead of blindly following public opinion. This philosophy applies far beyond investing. Independent thinking creates clarity in many areas of life. Financial intelligence versus financial emotion. The book repeatedly demonstrates that financial success is not purely mathematical, it is psychological. People often know what they should do financially, but emotions interfere. Fear, impatience, greed, ego. The intelligent investor learns to manage emotions instead of becoming controlled by them. This emotional mastery becomes more valuable than complicated predictions. Modern relevance. Even though The Intelligent Investor was written decades ago, its lessons feel more relevant than ever today. Modern markets move extremely fast. Social media amplifies financial hype. People chase trends emotionally. Cryptocurrency booms, meme stocks, fear-driven crashes. Human psychology has not changed. Fear and greed still dominate markets, which makes Graham's principles timeless. Wealth beyond money. Although the book focuses heavily on investing, its deeper lessons involve discipline, patience, and rational thinking. The intelligent investor avoids emotional extremes. They focus on stability instead of chaos, long-term growth instead of instant gratification. This mindset often creates peace alongside financial success because emotional discipline improves decision-making in every area of life. And final lessons. At its core, The Intelligent Investor is a book about rational thinking during emotional environments. It teaches readers to think long-term, control emotions during uncertainty, focus on value instead of hype, protect themselves through margin of safety, stay disciplined during market chaos, and build wealth patiently over time. Perhaps the most important lesson is this: successful investing is not about being smarter than everyone else. It is about being more disciplined than everyone else. Conclusion. Thank you for watching. If you enjoyed this summary of The Intelligent Investor, make sure to like the video, subscribe to Peace Mind, and turn on notifications for more fascinating book summaries and powerful life lessons. And remember, markets will always rise and fall. Fear and greed will always exist, but patience, discipline, and rational thinking remain timeless advantages. See you in the next video. Peace.